back, let's take a look at the shares of Agnico Eagle Mining, one of the big gold mining stocks, of course, on the S&P TSX Composite Index, down today, but up 123% over the past 52 weeks. The company has released fourth quarter results, and we're delighted to be joined by the company's Chief Executive Officer, Ammar Al-Joundi. He's President and CEO of Agnico Eagle Mines. Ammar, thanks a lot for coming in.
Paul, always a pleasure.
Okay, so record annual gold production in the quarter. So you and your team delivered on production, almost 3.5 million ounces of gold produced. And one of the things that really jumps out is the cost at which that gold was produced. There's a couple of different ways to measure those costs, but the number that is referred to as all-in sustaining costs, which I think our viewers are familiar with, was just over $1,200 per ounce. So that made for a pretty profitable year.
It made for an exceptional year. I mean, to put that into perspective, with the gold price where it is, Paul, at $1,200 all-in sustaining cost, that's $1,700 per ounce of margin. That led to a record year for us. You combine that with record production, of course, you're going to get record earnings, record cash flow, and a record share price.
How do you and your team and the people at the mines work to push those numbers down or to contain them, those cost numbers? There's a range of factors, some that you control and others that you cannot control.
Absolutely right. Some we can control, some we can't. Look, cost is tough for everybody. Everybody works hard. But Paul, I would say we have a competitive advantage, and I'll explain why. We're not global. We view ourselves as regional. We're spread throughout the world, but we focus only on what we think are the best regions. Mm-hmm. And in Canada, for example, we produce more than half the gold in Canada. We produce more gold, obviously, than everyone else combined, and we've been in the same region for decades. That means while we can't control everything, we have less volatility than most of our peers. We are the best customer for 50 years. We get the best contractors. We get the best suppliers. So it does really give us a bit of a benefit. And when you add to that, a lot of our costs are in Canadian dollars. Mm-hmm. We have the tailwind of a depreciating Canadian dollar, which we've had.
Through its history, the company has consciously avoided jurisdictions that have political risk. Is that correct to say?
We have. We look at two key criteria. First, there has to be the geologic potential, of course, for multiple mines, because that's what gives us that advantage. But Paul, we also look for regions that have the political stability to operate for decades. And it's always worked for us. It's worked for us for 68 years. But I would argue that right now, being in safe, good jurisdictions is more important than it's ever been.
I believe one reason the stock is down today is that the company has trimmed its guidance for 2025 and 2026 on production. Tell us what the guidance is and what led to the change.
Yeah, the midpoint of our guidance is about 3.4 million ounces. To put that into perspective, that's only down about 2% versus what we did in 2024, which was a record year. The top end of our guidance, if we meet that top end of our guidance, we'll actually be producing more gold than we did. So it's a very small adjustment, and it really has to do primarily with one mine in Mexico where they have some ground conditions that we're being a little bit more careful. Safety always has to come first. And then some minor resequencing. So a very small adjustment for 25, 26. If we hit the top end, then actually it'll be additional record years. But what I really think is important is 2027, we have consistent, steady guidance all the way out for 3 years.
You're a big gold producer now. You just mentioned you produce more than half the gold in Canada. Is it true that when you get bigger, it's more difficult to achieve meaningful growth? And do you want to significantly increase ounces mined?
We want to increase ounces per share. We want to increase profit per share. We've never actually cared how big we are. Mm-hmm. You know, this year, we're just, in 2025, our guidance, we're just below Newmont. We're going to be the second largest producer in the world. We're very close to Newmont in market cap, but what we care about are per share metrics, creating value per share. So, as you get bigger, does it get harder to find more gold? No, not necessarily. I would argue we have a competitive advantage because of our size and because we operate in the best regions.
Where are the key projects now where Agnico's future gold will come from?
Depends how much time you've got, but let me tell you the ones we're most excited about. Detour, we think we can get that mine to over 1 million ounces a year. Malartic, we have a vision to over 1 million ounces a year. In the entire world, right now there are only 4 mines that produce 1 million ounces a year. So we could have 2 of the 6 million ounce plus mines in the world, in the best jurisdictions in the world, 100% owned by one company. There's also Hope Bay, which we think could help us get our Nunavut platform close to 1 million ounces a year for decades. There's also San Nicolas, which is a joint venture with Teck in Mexico that we're working on. Really, I've been in this business for 25 years. We've never had a better pipeline than we do now.
What about M&A? The company has in its history grown substantially. I think a lot of viewers would still remember the Yamana Gold transaction of several years ago. That's where Malartic came from, correct?
The second half. We had half.
Correct. What's the company's posture on M&A?
Well, we like to create most of the value either through the drill bit, which historically we've done, or by converting what's in the ground to cash above the ground, building mines, operating mines. Sometimes we do M&A. It's our job to look at M&A. It's our job to look at opportunities. Just recently, Paul, we're in the process of acquiring O3, a project a few kilometers away from our Malartic mill. So we do look at M&A. We look at it strategically. But we don't want to grow through M&A. Mostly we want to grow organically.
Thank you so much for coming in.
My pleasure. Nice to see you.
Ammar.